Hi everyone, this is Victor here. Welcome to the Intelligent Investor channel. I posted this video 2 months ago to talk about how I started investing with $5,000 and how I grew this growth stock portfolio to over $500,000 through systematic savings and investing every month. In today's video, I'm going to talk about how to pick the best stocks and outperform the market, the S&P 500 index. As an example, I will share with you how this growth stock portfolio has grown from $530,000 to $607,000 in 2 months. I will talk about some of the winners and losers. I will talk about the 5 rules that can help you pick the best stocks and outperform the market. I will cover these topics in this video. Rule number 1, why invest in what you know. Rule number 2, how to find outstanding businesses. Rule number 3, how to invest at a fair price or an undervalued price. Rule number 4, invest for the long term to achieve multi-baggers. Rule number 5, sell if there are no longer outstanding businesses. And what are the key takeaways? If you like this video, smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and portfolio review videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon in the video description and become a VIP patron. You'll be able to follow all the stocks I'm buying for the long term. Also, you'll be able to download the latest intrinsic value calculators for all the stocks I'm analyzing, so you know when a stock is overvalued, fairly valued, or undervalued. The link is in the video description. Take a look. Let's start. To pick the best stocks and outperform the market, the first most important rule is to always invest in what you know. In other words, it is always best to stay within your circle of competency and only invest in stocks and businesses you understand the most. For example, if you understand technology like me, it's best to stick with tech stocks you understand the most. If you work in the healthcare industry, you can find great stocks within the healthcare industry much earlier than the Wall Street analysts and fund managers. If you work as an IT professional or a software engineer, you can find great stocks in the tech industry or in the same industry you work in much earlier than the Wall Street analysts and institutional investors. I will give you an example here. I love investing and analyzing stocks. My specialty is tech stocks because I enjoy and understand technology the most. I always like to look for the best tech companies with increasing earnings and increasing economic moats that will become mega caps such as Apple, Amazon, Microsoft, Facebook, Alphabet, and Tesla. If you look at my growth stock portfolio here, it has now grown to $607,412. 2 months ago, it was $530,004 when I made this portfolio review video. Within these 2 months, I added $7,451 cash into this growth stock portfolio. This means the rest, $69,957 gain, is mainly from the stock's unrealized gains. So how do you apply invest in what you know in a growth stock portfolio? If you look at my growth stock portfolio here, the first thing you will notice is that I only invest in tech growth stocks. I mentioned this earlier, I understand technology the most, and my specialty is tech stocks. I like to stay within my circle of competency and find the best stocks in the tech industry. If you ask me to analyze healthcare stocks, biotech, and oil and gas stocks, I will not be able to analyze them because I don't fully understand them. The second thing you may notice is that there are several multi-baggers in this growth stock portfolio. Some of these multi-baggers include PayPal, Apple, Microsoft, and Visa. I invested in PayPal right after it was separated from eBay in 2015 because I knew PayPal was the most popular digital wallet and platform to send and receive money online between friends, families, and even businesses. I invested in Apple many years ago because I saw everyone around me was addicted to using their iPhones and iPads. They were spending a lot of money on the iOS App Store. I invested in Microsoft many years ago because I noticed most people still used Windows PC and Microsoft Office at work. I noticed Microsoft's Xbox gaming console was becoming very popular. I also noticed Microsoft was becoming a huge player in the public cloud business. I invested in Visa and MasterCard many years ago because I saw most people used Visa and MasterCard much more than American Express. I noticed people were spending much more money using their credit cards than using cash. Another reason to invest in what you know is to reduce risks. If you invest in stocks you don't understand, you will not know whether the stock is a good business. You will not know when to buy and when to sell. If you invest in stocks stocks you don't understand, you will likely follow what the crowd is doing or what everyone else is buying and selling. If you see the stock you like is going up quickly, you may buy the stock even if you don't fully understand it because your fear of missing out. Now, I made this mistake several times in the past. If you see the stock you invested in is crashing quickly, you may sell the stock because you're afraid the stock will drop further. I also made this mistake in the past. For example, I made the mistake of selling my Tesla shares before. If I held onto my Tesla shares, it will grow at least 10 times by now. To outperform the market, I believe the second most important rule or principle is to look for the best businesses around us that have increasing earnings and increasing economic moats. Once you follow the rule of investing in what you know, your next step is to find the businesses around you that have increasing revenues, increasing earnings, and great competitive advantage or economic moats that can protect the business from the competition. I will give you several examples here. Personally, I would not invest in retail businesses such as Starbucks and Best Buy, even though their stocks did very well in the past, because I don't think they have many competitive advantage. I also don't invest in telecommunication stocks such as Verizon and AT&T, even though they pay high dividends, because they don't have great economic moats that can protect their services from lower pricing from competitors. So how do you find great businesses and stocks around you? You can find many great businesses around you by just observing what everyone is buying and using every day. This is what we call local knowledge. Of course, you will still need to do your homework first before investing in any stocks. You will need to study their businesses, study their financials, understand their risk and competition, and understand their future economic prospects before investing in any stocks. For example, if you see a lot of people using services such as Amazon and Google, this means Amazon and Google are likely great businesses because most people use them. If you look at my growth stock portfolio here, you can see my top holdings are Apple, Microsoft, Amazon, Alphabet, Facebook, and Tesla. I invested in these companies because they're the best businesses in their industries. They're the market leaders in their sectors. They have increasing earnings and increasing economic moats. Apple, Microsoft, Amazon, Alphabet, and Facebook's businesses are near monopolies. It's almost impossible for new competitors to compete with them. When it comes to investing, I learned this important lesson. You do not need all your stocks to be winners. You just need several large winners, also known as multi-baggers, because even one large winner's capital gain is often more than enough to offset all the unrealized losses. This is because the maximum loss for a stock is limited to 100% of your capital if you have a long position without leveraging. If you have a long position in a stock that is an outstanding business, the maximum gain is without a limit. This means the stock can reach over 100% if you pick the right one. For example, I added all the unrealized losses here from Alibaba shares to ARK ETFs here. The total unrealized loss is $17,628. Personally, I believe all these stocks will recover within a few years after the current Chinese regulatory crackdowns ease in China. Now, in comparison, just Amazon's unrealized gain of $21,000 is more than enough to offset the combined unrealized losses. This is why I like long-term investing much more. The key to picking the best stocks is to use our local knowledge to find the best businesses with increasing earnings and increasing economic moats. The third rule is to invest when the stock is fairly priced, or better, when it's undervalued. This rule is the hardest to follow because it's not easy to know if a stock is overvalued, fairly valued, or undervalued. Even if you can calculate the stock's fair interest value using the discounted cash flow DCF model or other valuation models, you still have to be very patient and wait until the stock drops close to or below its fair interest value before buying. For example, I used this intrinsic value calculator to estimate Apple's fair intrinsic value. Based on my intrinsic value calculation, if Apple's free cash flow grows at a 10% compound annual growth rate, CAGR, each year over the next 5 years, its fair intrinsic value should be around $140.85 per share, or $2.35 trillion. In comparison, at the time of making this video, Apple is traded at $149.1 per share, or $2.46 trillion in market cap. This means Apple is likely fairly valued or slightly overvalued. If I want to buy more Apple shares, I will buy when the stock drops below $140.85 per share, so there will be a good margin of safety to reduce risks and to increase the potential return. But here's the catch. If you want to learn about how to value stocks to find the stock's fair intrinsic value, you will need to study the business, study its financial statements, understand its future growth prospects and risks. and use valuation models such as the discounted cash flow DCF model or the price to sales PS valuation model to estimate the stock's fair intrinsic value. Based on my experience working in the financial industry for more than 12 years, I noticed that most investors will buy the stock if they believe the stock price would go up in the future, or sell if they believe the stock price would drop without knowing what the stock's fair intrinsic value is. Warren Buffett always says this: be fearful when others are greedy and greedy when others are fearful. So how do you apply this investing principle if you don't have the time and expertise to value stocks using the DCF model or other valuation models? Personally, if I don't have the time to value a stock's fair intrinsic value, I will wait until the stock drops between 10% and 20% from its recent peak before buying the stock. For example, Apple is currently traded near the peak. Its share is traded at $149.1 per share. If I don't have the time to value Apple's fair intrinsic value, I will wait until the stock drops about 10% to $134.19 per share before buying it. This is to make sure I don't overpay the stock. You can also wait until there are large corrections and dips in the entire stock market. On any given day, if you're investing in growth tech stocks like me, you'll notice that tech stocks can easily drop 3%, 5%, or even more than 10% on any given day. If the entire stock market is very pessimistic because the market is afraid of high inflation or because the US Fed is increasing its interest rate quickly, you see all the stocks drop very quickly. This is the best time to be greedy when others are fearful and to buy more shares of outstanding businesses. Of course, it is important to stay away from value trap stocks, even though they have a very low price to earnings ratio. Value traps are stocks that appear to be undervalued with very low multiples, but in fact they have very low multiples because their businesses are not doing well, or their revenues are not growing, or they are no longer competitive in their industries. Personally, I would stay away from value trap stocks even if they appear to be undervalued with very low multiples. To outperform the market, the fourth rule is to always invest for the long term, so you can have multi-baggers in your portfolio. If you always invest in what you know and find the best businesses around you that have increasing earnings and increasing competitive advantage, you have a much higher chance of finding multi-bagger stocks. Multi-bagger stocks are stocks that can grow 2 times, 3 times, 4 times, 5 times, 10 times, or even more in the long run. For example, if you look at my growth stock portfolio here, you can see my multi-baggers include Apple, Adobe, Amazon, Alphabet, MasterCard, Mercado Libre, Microsoft, PayPal, and Visa. I expect all these stocks will continue to grow exponentially over time because of their increasing earnings and their increasing economic moats in their businesses. Here's the important part: all these stocks did not become multi-baggers overnight. I have invested in them for many years. In the beginning, some of them even dropped more than 20%, but they have all grown exponentially over time because of their increasing earnings. In the long run, it's always the business's earnings and cash flows that determine the stock price. To outperform the market, the fifth rule is to sell only when the stock is no longer a great business. This rule is opposite to what is taught in school and what is taught in the investing industry. Now, many investors and portfolio managers will sell a stock if it has increased substantially in value because they want to rebalance their portfolios and reinvest the gains in other more undervalued stocks. Personally, I believe a much better approach is to sell only if the stock is no longer an outstanding business, and to keep investing in the best businesses for the long term to achieve multi-baggers. If you have a winning stock with an outstanding business that has increasing earnings and great economic moats, I don't think it makes sense to sell the winning stock to reinvest in other stocks that are likely more inferior businesses. For example, I made the mistake of selling Amazon, Nvidia, Shopify, Visa, and MasterCard shares before. If I held their stocks until now, my current growth stock portfolio would be much larger. I also made a huge mistake of selling my Tesla shares before. If I held my Tesla shares, it would be worth at least 10 times by now. So the key lesson I've learned is to only sell a stock if it's no longer an outstanding business. Instead of selling the winning stock to rebalance a portfolio, I would invest in it for many years and keep buying more shares as long as the stock is an outstanding business with increasing earnings and increasing economic moats. So here are the key takeaways. First, always invest in what you know. Second, find the best businesses that have increasing earnings and great economic moats. Third, buy the stock when the price is fair or when it's undervalued. Fourth, invest for the long term to achieve multi-baggers in your portfolio. It took me a long time, more than 12 years, to learn how to invest, how to analyze stocks, how to pick the best stocks, how to value stocks, and how to manage stock portfolios. I had to study hundreds of company financial reports and study writings from Warren Buffett, Benjamin Graham, and Peter Lynch to figure out the investment style and portfolio strategy that work best for me. There are many ways to invest, there are many investment strategies. At the end of the day, you have to find out what strategy works best for you. You will need to do your research and do your extra due diligence first before investing in anything. Investing in what you know is the most important key to picking the best stocks and outperforming the market. If you like this channel, smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and portfolio review videos every week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a VIP patron. You'll be able to follow all the stocks I'm buying for the long term. Also, you'll be able to download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock is currently overvalued, fairly valued, or undervalued. Thank you for watching this video. This is Victor from the Intelligent Investor channel. I will see you in my next video.